Good morning, fellow students. Welcome to part 2 of our exam preparation, where we are working through question 2 of the May-June 2022 exam. So this is part 2 of this question. So I would suggest that you first view part 1, where we have worked through points 1 to 6. Okay, we have started with point 6. In part 1, but then we had to cut short that video. So we will be completing points 6 to 9 in this video. As I've indicated in the first part, even though the question only requires us to draft the consolidated statement of profit or loss and other comprehensive income and only certain columns in the consolidated statement of changes in equity, I have taken the decision to draft all the group's financial statements. Okay, so we will be doing the consolidated statement of profit or loss. We will be doing the consolidated statement of changes in equity in full, as well as the consolidated statement of changes or financial position rather. Okay, the consolidated statement of financial position. Okay, so as I've said, we have finished points 1 to 5. So please just go back to part 1 to study those calculations very carefully. Now, just to recap point 6. Now, remember that point 6 was about an intergroup sale of equipment from the subsidiary to the parent. Okay, they have given us the carrying value of the equipment at the beginning of the year, which is the 1st of April 2019, and the equipment was sold intragroup for 1.053 million on the 30th of November 2019, and the group provides for depreciation on a straight line basis at 10% per annum. Now, in part 1, we have calculated the additional depreciation written off by the subsidiary on this equipment because we have to calculate the carrying value of this equipment on the date of sale, which is the 30th of November, in order to work out the profit made by the subsidiary correctly. Okay. We got an amount of 69,000, and you will also recall that we have used the reducing balance method, not the straight line method as they have indicated, because they only give us the carrying value of the equipment. Okay, there's not enough information to actually calculate the cost of the equipment itself. Okay, so therefore, for the purposes of calculating the additional depreciation written off on this equipment, we will be using the reducing balance method, thereby writing off depreciation on the carrying value of the equipment and not on its cost. Okay, so you should have arrived at an amount of 69,000, and then we had to determine the portion of that amount that must be allocated to the pre-acquisition period and the portion that must go to the post-acquisition period. Okay, now from the 1st of April or the 1st of April 2019 to the 30th of November 2019 covers a period of 8 months. Okay, and we know from our notes that we've made in part 1 that the pre-acquisition period runs from the 1st of April 2019 and ends on the 31st of August 2019, the date of acquisition, giving us a total of 5 months. Okay, so this means that 5 months of this amount must be allocated to the pre-acquisition period, and the remaining 3 months must go to the post-acquisition period. Okay, so we have used 5 because we want the amount for the pre-acquisition period, and we have divided by 8 because we have a total of 8 months depreciation in this amount of 69,000. Okay, so the amount that must go to the pre-acquisition period is 43,125, and the remaining amount will go to the post-acquisition period, that being the 25,875. Okay, the reason why we do this is to indicate that we cannot split this amount evenly between the two periods. Okay, because a certain portion was incurred in the pre-acquisition period and the other portion was incurred in the post-acquisition period, and we need to include it as such in our calculation of the pre-acquisition and post-acquisition profits. Okay, so now that we have determined that, we actually need to first calculate the intergroup profit. Okay, so since this was an intergroup sale of equipment, there will be an unrealized profit that we need to eliminate. There can also be a loss, okay, it depends on the carrying value, but in this case it will be an unrealized profit, okay, so we have to eliminate the unrealized profit, and furthermore we need to eliminate the unrealized depreciation as well. Okay, so let's first calculate the unrealized profit made on this intergroup sale of equipment. So the unrealized profit, okay, is calculated by taking the selling value of the equipment itself, which was 1,053,000, because that was the amount paid by Runet Limited. Okay, Netix Limited sold the equipment to Runet Limited. Okay, and then we have to subtract the carrying value of the equipment on the date of sale, which is calculated by taking the carrying value at the beginning of the year, which was 1,035,000. Okay, this was given, and then we have to subtract the additional depreciation written off of 69,000. Okay, and if you have calculated this correctly, you should arrive at an amount of, let me just calculate this. So you should arrive at an amount of 87,000. Okay, so 87,000 Rand represents the unrealized profit that was made by Netix Limited. Okay, now because it was made by the subsidiary, okay, we have to include the unrealized profit in full in the post-acquisition period. Okay, according to your information, the date of sale was on the 30th of November 2019, which means that the profit was made on that date. So how will it affect our calculations? Remember that the profit made by Netix Limited will be included in its other income. Okay, and because it was made in the post-acquisition period, we need to include the full amount as such. So 87,000 Rand, which is part of other income, must be allocated in full to the post-acquisition period because it only relates to that period. Okay. Now that we have addressed that, we need to actually eliminate the unrealized profit. So our journal entry will be, because the profit was made in the current year, we will debit other income for Netix Limited, okay, because we actually need to decrease the profit that they've made by debiting other income, okay, 87,000, and remember that the profit is included in the equipment of Runet Limited. Okay, and according to your trial balance, they have only given us the item of property, plant, and equipment. Okay, aside from land and buildings. So therefore, we will credit. Just put this down. So therefore, you will credit PPE, okay, or property, plant, and equipment for Runet Limited by the same amount of 87,000. Okay. Remember, since we are doing all the consolidated financial statements, we will adjust it at every place that it has an effect. So, in your consolidated statement of profit or loss and other comprehensive income, let me just open that document. Open FAC2601 examination. Okay. So remember, it needs to be subtracted from the group's other income. We will still calculate the amount for the post-acquisition period, which we will add to these amounts, okay? But we have shown the elimination of the unrealized profit in the group's other income, okay? Because it occurred in the post-acquisition period as well. Okay, so it will decrease the group's profit. And then for your property, plant, and equipment, we will go to the consolidated statement of financial position. So you will first start with the items as given in your trial balances. So we start with land and buildings. Okay, 8,742,960. Okay, then we add the 6,162,970. Okay, once we have entered a certain amount, we will just cross it out. Then we have property, plant, and equipment. Okay, 2675 800, and then we add 3579 073. Okay, and then we need to subtract the unrealized profit of 87,000, and this is shown in calculation 1. Now, the reason why I say that it will be included in calculation 1, keep in mind the subsidiary made the unrealized profit on the equipment, so therefore the unrealized profit adjustment must be shown in the analysis of owner's equity because the subsidiary made the profit. Okay, there's no accumulated depreciation that we need to subtract, so this is displayed at carrying value, okay, which is correct. Alright, so in your analysis of owner's equity of ordinary share capital, you will show the adjustment of unrealized profit. Let me just put the other things down. So we are calculating the profit for the post-acquisition period after adjustments. Now, what will these adjustments be? We will start with the profit as calculated. We are still calculating the post-acquisition profit, okay, for the subsidiary according to calculation 3. So we will still input an amount right here. And then we need to show the elimination of the unrealized profit. Unrealized profit included in Runate Limited's equipment or property, plant and equipment. And since it is eliminated, it decreases the actual profit made by the subsidiary. Okay, so therefore we show it as a negative amount because the profit that is eliminated decreases the actual profit made by the subsidiary. Okay, this amount right here will be the post-acquisition profit that we will calculate here. Okay, and once again, why have we shown the adjustment here? Because the subsidiary made a profit, so therefore it must be shown in the analysis of owner's equity. Okay, so now that we have eliminated the unrealized profit, we now need to calculate the unrealized depreciation that must also be eliminated. And as you should know, we calculate the unrealized depreciation by taking the unrealized profit into account. So we will take the 87,000 times the depreciation rate, which is 10%, and then we will multiply it with the number of months, or the period rather, from the 30th of November 2019, which was the date of sale, up until the end of the current financial year, which is the 31st of March 2020, and that should give you a total of 4 months. Okay, for December, January, February, and March. So that will give you a total of 4 months that we need to take into account for calculating the unrealized depreciation. Why do we calculate unrealized depreciation? It's because the parent, in this case, provides for too much depreciation, as the unrealized profit is included in the cost of the equipment. Okay, so they provide for too much depreciation, so therefore we have to remove the unrealized depreciation. And you should get an amount of 2,900. Okay, our journal entry, because the parent provides for too much depreciation, we need to debit the accumulated depreciation account, which has a credit balance. So we will debit accumulated depreciation for Runate Limited by 2,900. And since the unrealized depreciation pertains to this year or the current financial year, we will credit the depreciation expense of Netix Limited of 2,900. As I have indicated in part 1, keep in mind that when we are calculating the unreal or the post and pre-acquisition profits, okay, we do not show any eliminations here. We only include certain amounts in specific periods, okay? But the actual elimination will occur in your consolidated statement of profit or loss. Meaning that if you go to your consolidated statement of profit or loss and other comprehensive income, we know that depreciation will form part of administrative expenses. So by decreasing depreciation expense for Netix Limited, you are actually decreasing administrative expenses for the group. Okay, this will also be shown in calculation 1. Because the parent or the subsidiary made a profit, the adjustment regarding the unrealized depreciation must also be shown in your analysis of owner's equity. So we need to show the reversal of unrealized depreciation. Okay, and we have calculated that. This is just for completeness. You don't have to show it twice. Just make sure that the marker is able to see how you've calculated a certain amount. The same for the equipment. We have taken the selling value and then we subtracted the actual carrying value of the equipment on the date of sale. And that has given us the value of 87,000. Okay, and the depreciation reversed. Because the depreciation expense is decreased, we increase the profit made by the subsidiary. So therefore, it must be shown as a positive amount. Okay, because we are decreasing the depreciation expense, and that in turn will increase the profit made by the subsidiary. Okay, if the depreciation expense was increased, that will lead to a decrease in the profit. Then it will be shown as a negative amount. Okay, the same with the profit. Because we are eliminating a profit, we are decreasing the actual other income for the subsidiary. And because there's a reduction in other income, that will lead to a decrease in the profit for the year for the subsidiary. Okay, so now for 0.6, and this was a complicated adjustment, or you need to do a lot of calculations here, okay, because you first need to calculate the additional depreciation, you then need to split it between the pre and post acquisition periods, then calculate the unrealized profit as well as the unrealized depreciation. So this was quite a complicated calculation, okay. But with any adjustment, okay, if you're working with a certain point, work it through from beginning to end and then adjust it at every possible place that it will have an effect. Okay, keeping in mind the required section. Okay, so for this one, we have calculated the additional depreciation. We have split it between the pre and post acquisition periods. We have calculated the unrealized profit, which was also made in the post acquisition period. Okay, we have included it there. And then we have calculated the unrealized depreciation and we have eliminated both of them. Okay, we have eliminated the profit as well as the unrealized depreciation. Right. Okay, this will also be shown in calculation 1. The analysis of owner's equity of ordinary shares. Okay, keep in mind also that your calculations do not necessarily have to be in the same order as mine. Okay, it can be in any order as long as you reference all your calculations. Okay, make sure that your marker is able to see where you have calculated a certain amount. That will increase the probability of you not losing marks, okay, or you earning partial marks at least, okay, where your final amount is not correct. Okay, so we are done with 0.6. Right, let's move on to 0.7, where it says the following. Netix Limited had acquired a loan from Connect Bank on the 1st of March 2019. Okay, the 1st of March 2019 is clearly in the previous financial year, so we will calculate interest on that loan for the full year. Okay, so please just keep that in mind. Interest is levied at 8% per annum, payable on the 31st of August and 28th of February each year. Interest incurred for the year is included in other expenses. So this means that if you go back to your calculation for the pre and post acquisition profits, this amount right here will include finance costs, and we need to show finance costs separately in our financial statements. Okay, so we will calculate the total finance costs for the year, which is included in other expenses, and then we need to remove that portion and display it here. Okay, but let's read the information from beginning to end. So it's included in other expenses, and for the period 1 April 2019 to 31 August 2019, so for the pre-acquisition period, interest amounting to 29,600 Rand was incurred in and paid rather. So you can input that for the pre-acquisition period. Okay, they have given this value. Okay. the interest does not qualify for capitalization. So this means that the interest itself is not added to the loan account, okay, or to the loan balance itself. All right, and is expensed when incurred. Now, on the 31st of August 2019, the loan balance was 680,000, and the directors decided to settle the outstanding loan amount together with the related interest on the 1st of December 2019. Okay, now one thing that I have to mention is that you do not have to calculate the balance of the loan on the 1st of April 2019. Why? Because we are only interested in the amount for interest. Okay, and the amount for interest in the pre-acquisition period was given. Okay, so we do not have to work out the balance of the loan at the beginning of the year. Okay, because the interest for the pre-acquisition period was given. So we just input that as finance costs for the pre-acquisition period. However, we need to calculate interest for the full year, and since we have the interest for the pre-acquisition period, we can only calculate interest for the post-acquisition period using the balance of 680,000, which was the outstanding balance on the 31st of August 2019. So in your calculations, you will calculate the interest for the post-acquisition period. Interest on loan from Connect Bank for the post-acquisition period. Okay, because remember the pre-acquisition amount was given. Okay, so we only need to calculate the post-acquisition amount. So the post-acquisition amount will be taking the balance of the loan on the 31st of August 2019, which was 680,000, and the interest rate was 8%, and the number of months between the 31st of August 2019 and the 1st of December 2019, the date on which the loan was settled in full, together with the related interest, will be 3 months. Okay, September, October, and November. Okay, 3 months. Okay, that will give you the amount for interest on this loan right here. And you should arrive at an amount of 13,600 Rand. So 13,600 Rand represents the interest expense for Netix Limited, the subsidiary, for the post-acquisition period, and you will include it in your calculation right here. 13,600 is for the post-acquisition period. We have calculated that by using the outstanding balance of the loan on the 31st of August 2019 and calculate interest up until the 1st of December 2019. The amount for the pre-acquisition period was given. So it's unnecessary to calculate the amount outstanding at the beginning of the year. So your total finance costs for Netix Limited will be 43,200. Okay. Now keep in mind that the 43,200 Rand right here is part of other expenses. Okay, so therefore we need to actually show that we have removed the finance costs from other expenses. So therefore the actual amount for other expenses would be taking the amount of 2,876,000, let's rather do it this way. You take the amount of 2,876,310, and then you subtract the amount of 43,200. Because remember that the 43,200 is included in this amount, and we must show it separately. So therefore the actual amount for other expenses will be 2,833,110. Okay, 2,833,110 Rand. Okay, 2,833,110. Okay, that is the actual amount for other expenses, because 43,200 was finance costs. Okay, good. Now, just for the sake of completeness, let me show you how you could have actually calculated the amount outstanding at the beginning of the year. So if you wanted to calculate the loan amount outstanding on the 1st of April 2019, you will take the balance you actually then need to work backwards. Okay, so you will take the amount of 680,000. Okay, you then need to divide that amount by the interest rate, which is 8%, and then you have to multiply the answer by 12 over 5. Okay, because we have the interest. No. Let me just use the 29,600 rather. Let me see if this works out. I can't remember how I've calculated this. No. Okay. Let me do this another way. Sorry. Let me just show you right here. So remember that the interest for the pre-acquisition period, which was 29,600 Rand as given, was calculated by taking the amount outstanding on the 1st of April 2019. We then multiply that amount by 8%, and we multiply that by 5 over 12. Because that is the period or the number of months covering the pre-acquisition period. So therefore, this will just be a normal equation that you need to solve. So your amount on the 1st of April 2019 would just be taking the amount of 29,600 divided by 8% and then multiply the answer by 12 over 5. Okay, or you can divide by 5 over 12. That will give you the same answer, and you should arrive at an amount of 888,000. So this was the outstanding balance of the loan on the 1st of April 2019. But as I've said previously, it was unnecessary to calculate this amount because we are only interested in the interest amounts. And we have the outstanding balance on the 31st of August 2019, so we are able to calculate the finance costs for the post-acquisition period. Okay, I've just shown this for completeness. Okay, how will this affect our calculations? Okay, no intergroup interest there, so nothing is eliminated. However, we need to include the 13,600 Rand as part of the group's finance costs. Alright, so in your consolidated statement of profit or loss and other comprehensive income, you will show finance costs according to calculation 3. The group's finance cost would be 13,600 Rand. Now, you will see that no information is given regarding the finance costs for the parent. Okay, we do not know how much interest was paid by the parent or was incurred by the parent. So therefore, we assume that only the subsidiary paid finance costs, and that will be 13,600 Rand, which must be shown as part of the group's finance costs because this amount was incurred in the post-acquisition period. So there's not enough information for us to calculate the amount for the parent. Okay, so therefore we only include the post-acquisition amount for the subsidiary, okay, as part of the group's finance costs. Okay, so now we move on. Okay, no intergroup interest that we need to eliminate. We have shown the amounts for the pre and post-acquisition periods, and we have shown the post-acquisition amount for the group's finance costs. Okay, so this one is done. Right, let's go to point 8. Now, point 8 says that Netix Limited declared both ordinary and preference dividends on the 31st of March 2020, meaning that it was declared at year end. So with regards to the ordinary dividends, if you go back to your trial balance right here, you will see that the amount for ordinary dividends declared by Netix Limited would be 1,084,267. So in your analysis of owner's equity, you will show that amount as ordinary dividend paid. Remember to keep ordinary dividend declared rather, so keep this one separate from the adjustment of the profit. Okay, because ordinary dividends are not or do not present or represent an expense item. Okay, so it must be kept separate, and the amount of dividends paid would be 1,084,267. Okay, So we need to calculate the amount paid to the parent, because the parent itself is a shareholder of Netix Limited. And that will be 813,200 Rand. And the amount for non-controlling interest would be 271,067. Okay. What amounts do we use and where? Okay, firstly, remember that this was paid to the parent. So this will be included in its other income. And since it is an intra-group item, we need to eliminate this amount from the group's other income. So in your consolidated statement of profit or loss and other comprehensive income, you need to eliminate the intra-group dividends received. Okay, more specifically, the intra-group ordinary dividends received. Okay, that was calculated in calculation 1, the analysis of owner's equity, 813,200. And the amount paid to non-controlling interests would be shown in your consolidated statement of changes in equity. So if you go to your consolidated statement of changes in equity, you will show the amount for dividends declared. Ordinary non-controlling interest would be 271,067. Okay, that was the amount of dividends paid, or ordinary dividends paid to non-controlling interest for this financial year, 271,067. Okay, good. And keep in mind that we have eliminated the intra-group dividends. Okay, the dividends paid to the parent, because the group cannot pay dividends to itself. Alright, so that was the ordinary dividends, and the amount paid by the parent needs to be included in full in your consolidated statement of changes in equity. So the 198,400 will be shown here. It will be subtracted from retained earnings, because remember, this section right here will pertain to the parent. Okay, the equity attributable to owners of the parent. So in your retained earnings column, you need to show the amount of dividends paid by the parent as a negative amount. Okay, because we subtracted from retained earnings, 198,400. We include it in full because it pertains to the parent. All of the parent's items must be included in the group's financial statements, as I've also indicated in the previous lesson. Okay, so we have addressed the ordinary dividends. Now we need to address the preference dividends. Now keep in mind that we have calculated the preference dividends for the pre-acquisition period already. Okay, so we only need to calculate the preference dividends for the post-acquisition period, and it also needs to be adjusted against the profit. So you will insert another line here. Okay, let me just do this right. So this will be preference dividends for the post-acquisition period, because we have already dealt with the pre-acquisition period's dividends. So we will take the amount of 220,000, which is the value of preference share capital for the subsidiary. We'll multiply that by 12%, because that is the dividend rate. And we will multiply that by 7/12, because the post-acquisition period consists of a period of 7 months. And you should arrive at an amount of 15,400. Okay. Another way that you could have calculated this is by taking the total preference dividends paid or declared by the subsidiary, which was 26,400, and you could have subtracted the amount paid in the pre-acquisition period. You will also arrive at 15,400. Okay, and furthermore, if you want to calculate or make sure that you have calculated these amounts correctly, you can add together the amount of 15,400 and 11,000, and that will also give you 26,400 as reflected in your trial balance. Okay, so we subtracted from the profit for the post-acquisition period, and then we need to transfer this amount to the analysis of owner's equity of preference share capital. So in your analysis of owner's equity of preference shares, you will have a since acquisition to the end of the current year section. So your profit attributable to owners of the parent, profit attributable to preference shareholders. Okay, and this is for the post-acquisition period. Okay, so the total that we have calculated in calculation 1 Let me just correct this. This is from calculation 1. That being the 15,400. Okay, so 12,320 goes to the parent and 3,080 Rand goes to the non-controlling interest. And then we need to show that the preference dividends were declared. Okay, so these dividends are not in arrears. We have declared the preference dividends of 15,400. Okay, if it was declared or paid, you need to subtract it again to show that the preference dividends are not in arrears. So therefore, we will not transfer this amount to the following financial year. Alright, once again, we need to remove the intergroup dividends paid to Renet Limited because the group cannot pay dividends to itself. So the 12,320 was paid to the parent and will be included in its other income. So therefore, in the consolidated statement of profit or loss, you need to subtract the amount of preference dividends paid intergroup, which is 12,320, and we have calculated that amount in calculation 2. The analysis of owner's equity of preference shares. Alright, now keep in mind that we do not eliminate the 8,800 again because this would be eliminated any case. Okay, the elimination of owner's equity at acquisition. So the amount received for the pre-acquisition period of 8,800 Rand was already eliminated at acquisition, as part of the elimination of owner's equity. Okay, so we do not remove this amount again. We only remove the intergroup dividends paid because remember, this one could not really be intergroup dividends because the group was not formed in the pre-acquisition period. So what I'm trying to say here is that you only need to remove the preference dividend paid in the post-acquisition period. Okay, only that will be included in its other income because the amount for the pre-acquisition period was used in order to calculate the amount of goodwill. So it was already, in a sense, eliminated. Okay, so please keep that in mind. That is very important. So we also need to show this in our consolidated statement of changes in equity. Only the amount for non-controlling interest will be shown. So under your or in your non-controlling interest column, you will show the amount of 3,080 Rand as preference dividends declared to non-controlling interests. Okay, the amount for the parent is eliminated in the consolidated statement of profit or loss and other comprehensive income right here. Okay, good. What am I going to do next? Okay, and then you will notice that the preference or no preference dividends were declared by the parent because the parent has not issued any preference share capital. Okay, only the subsidiary has preference share capital. That is why we do not have an amount for preference dividends declared for the parent. Okay, so that is what you should have done. So 4.8, you should have calculated the intergroup dividends paid, okay, to the parent, and you need to eliminate these amounts both for ordinary and preference dividends in your other income line in the consolidated statement of profit or loss and other comprehensive income, and in your consolidated statement of changes in equity, you need to show the amount paid to non-controlling interests both for ordinary and preference dividends. And with regards to the ordinary dividends, you need to include the full amount paid by the parent, as 100% of the parent's items are included in the consolidated financial statements, and that amounted to 198,400. Also remember that dividends are not expense items. Okay, now we get to the final point, point 9, which gives you the profit after tax for both periods, and you may assume that all income and expenditure were earned and incurred evenly throughout the year unless otherwise stated, and then they also give you the income tax expense amounts for the pre and post acquisition periods. Okay, so now that we are done with all the adjustments, we can allocate the remaining amounts evenly between the two periods. Okay, meaning if we go to other income, we will calculate the amount for the pre-acquisition period by first removing the amount of 87,000 because that was the profit made in the post-acquisition period. So only the difference between these two can be split evenly between the two periods. And we'll multiply that answer by 5/12 because that is for the pre-acquisition period. That will give you 3980792. And then the difference will just be allocated to the post-acquisition period, which will be 5660108. Now, for other expenses, okay, and you need to be careful when calculating this one. We take the total of 2833110 because that is the actual value for other expenses for the subsidiary. We then need to remove all the amounts that are included in specific periods. So we first need to remove the 43,125, which must be included in the pre-acquisition period. And then we need to remove the 700,000, the 750, as well as the 25,875. All three of those amounts pertain to the post-acquisition period. So the amount that you have calculated here can be split evenly between the two periods. Okay, so we will multiply that answer by 5/12. Then you get an answer of 547546. Okay, but remember that we still need to include, or we need to add back the 43,125 because that must be included in the pre-acquisition period. We have just removed it in order to calculate the portion or the amount that can be split evenly. So we will take the amount of 547,546, which excludes the 43,125, and we need to add back the 43,125, which must be included in the pre-acquisition period in full. So the total amount for the pre-acquisition period for other expenses would be 590,671. Okay, this is a difficult calculation. As I've said, I don't think I said this in the first part. This question is about how as difficult as it gets. Okay, this was a pretty difficult question. I would rate it at a 9 on a scale of 1 to 10 in terms of difficulty. Okay, this was definitely a 9. There are a lot of calculations involved, and especially with this one, when allocating the amounts between these two periods, you need to focus. Okay, so this question was difficult. Okay, I will definitely not argue with that. And then logically, if you have calculated the amount for the pre-acquisition period, the remaining amount will go to the post-acquisition period, meaning that this will be your amount for other expenses for the post-acquisition period. Okay, 2,242,439. We have already allocated finance costs between the two periods. And then for the income tax expense, they have given us the amounts for both periods. It says that income tax expense for Netix Limited amounted to 834,991. And it amounted to 1,185,029. Okay, 1,185,029 for the post-acquisition period. Just for checking, if you add these two amounts together, it should give you the total income tax expense for the year of 2,020,020. Right. And don't forget that we still need to split revenue. There was no further information on revenue, so we can split this evenly between the two periods. So we will take 13,743,000 and multiply that by 5/12, as we want the amount for the pre-acquisition period, and then the remaining amount will just go to the post-acquisition period. Okay. Now, if your calculations were correct, you should arrive at these amounts right here, both of which should give you the total profit for the year, 8,564,640. And if you go to additional information point 9, just for confirmation, they have given you the profit after tax for the subsidiary, 4,658,892 for the period of 1 April 2019 to 31 August 2019. Okay, so immediately we know that our calculations are correct. Okay, so it's 4,658,892 for the pre-acquisition period, and 3,905,748. 3,905,748 since acquisition to the end of the current year, so in other words, for the post-acquisition period. So I was delighted to see this section right here, because then we immediately know that our calculations were correct. Okay, but that's also why I said that this question was not easy at all. Okay, so this is for confirmation to prove that our calculations were correct. So if you have calculated the amounts for the pre and post acquisition periods and you did not arrive at those amounts, logically there would be a mistake in some of your calculations, or just one of your calculations. But that is why I say it's so important for you to focus whenever you work through the points under additional information. You need to actually know the procedures. Okay, and I know it's not always that easy, but as you can see right here, this is about as difficult as it gets. Okay, so if you have managed to calculate this correctly, then you should. I wouldn't say you are completely set for the examination on the 24th of October, but out of all the questions that I've done in recent weeks, this was the most difficult one. Okay, right, so let's continue. Okay, so we know that our post and pre-acquisition profits are correct. Let's first complete our consolidated statement of profit or loss and other comprehensive income. So as I've said previously, we need to include all the amounts for the post-acquisition period as part of the group's items. Okay, so for revenue, we will add the amount of 8,016,750 to the group's revenue item. So for revenue for the group, it would be adding 8,016,750. Okay, 8,016,750. That is according to calculation 3. Then we will add the amount for cost of sales, which is, we have already added that. Okay, the 6,330,042. We have already taken that into account. Please do not add it again. Then for other income, it will be 5,660,108. Let me just make sure. Yes, 5,660,108. That is according to calculation 3. Keep in mind, this amount right here includes the unrealized profit of 87,000, which we have eliminated already. So please do not eliminate it again. Then for other expenses, which will actually be your administrative expenses, it will be 2,242,000. Let me just calculate this. 242,439. Okay, 242,439. Okay, that is according to calculation 3. Okay, also keep in mind that this amount right here includes the unrealized depreciation, which we have eliminated, as well as the intergroup lease payments that we also have eliminated already. Okay, we have shown finance costs for the group, and then your income tax expense for the group would be that of the parent, which is, let me go back to my trial balance. So your income tax expense for the parent is 4,004,490. And then we add the income tax expense for the subsidiary for the post-acquisition period, which we have calculated, or we have been given this amount actually, 1,185,029. Okay, this amount was given. And the additional information point 9. So 1,185,029. Okay, refer to calculation 3. Although we have not actually calculated this amount because it was given. If you go back to additional information point 9. Okay, 1,185,029 for the post-acquisition period. Okay, and then your revaluation surplus. Remember, there was a revaluation for the subsidiary, and we have shown this in our analysis of owner's equity under additional. Let me just go back here. We have shown it here. Okay, the current year's revaluation surplus amounting to 357,000. There was no revaluation in the records of Runet Limited. As per additional information, point 2. Okay. That's why I said it's important for you to first work through part 1 before you work through this video. Okay. Now we can calculate all our amounts for the consolidated statement of profit or loss and other comprehensive income. So for revenue, okay, I'm just going to save some time and copy this. Okay, calculate that. Yes. Okay, you should arrive at this amount right here. 36,448,580. Okay, for revenue. Okay, I'm just going to do it on my calculator. 17,903,640 minus 1.3 million, the elimination of intergroup sales, plus the amount of cost of sales for the post-acquisition period for the subsidiary, and then we have added the unrealized profit included in closing inventory, and that will give us an amount of, okay, we have actually calculated this is just for confirmation, 23,299,147. Okay, I've just made sure that we have calculated that correctly. Other income, 11,088,000 minus 750 minus 87 minus 813,200 minus 12,320 plus 5,660,108, and you get an amount of 15,085,588. Okay, 15,085,588. Your administrative expenses, or for your administrative expenses, you should arrive at an amount of 6,373,659. Okay, that is the amount for administrative expenses for the group. 6,373,659. We have already accounted for finance costs. Then we calculate our income tax expense. And that should give you 5,189,519. Alright. And if you add your other comprehensive income, you'll get the total comprehensive income for the year for the group, which is 17,015,243 Rand. Now, before we calculate this section right here, we need to return to our analysis of owner's equity for ordinary shares. Okay, especially the since acquisition to the end of the current year section. So we first had to calculate the profit for the post-acquisition period, and according to calculation 3, that amounted to 3,905,748. Okay, 3,905,748. This is what for the post-acquisition period. So your profit after tax, after all adjustments have been made for the post-acquisition period, should amount to 3,806,248. Alright, and then we calculate the portion attributable to owners of the parent, as well as the portion attributable to non-controlling interests. Okay, so how do we calculate the bottom section right here? Now, as I've also said, I think I said it at the beginning of part 1 or the first lesson, I prefer calculating the non-controlling interest amount first, and then just subtracting this amount from the total in order to give us the amount attributable to owners of the parent. Okay, now how do we actually calculate the amount attributable to owners of the parent, or to non-controlling interest rather? So we first take the portion of revaluation surplus. Okay, because remember, revaluation surplus is part of total comprehensive income. So we start with the 89,250 because that occurred during the post-acquisition period. So it's part of the group. So 89,250, which is according to calculation 1. Okay, then we add the NCI share in the profit after adjustments have been made. So after adjusting unrealized profits and unrealized depreciation, and after we have removed the preference dividend for the post-acquisition period. Okay, we then add the amount of 951,562. 951,562. This is according to calculation 1. And then we also need to add the profit attributable to your preference shareholders, the NCI share and that amount, which was the 3,080 Rand. Okay, only the since acquisition to the end of the current year amount. Okay, so this amount must also be added. 3,080, which is according to calculation 2. The analysis of owner's equity of preference shares, and you should get a total amount of 1,043,892. So 1,043,892. So your owners of parent will just be the remaining amounts, 17,015,243, and we subtract the amount for non-controlling interests. So we just take this amount and then subtract this amount right here. That will give you 15,971,351. Okay, so we are done with the consolidated statement of profit or loss and other comprehensive income. Let me just see how long this is. Okay, let me take a break and then we will complete the rest of the group's financial statements. Okay, but your consolidated statement of profit or loss and other comprehensive income should look like this. I'll be right back. Hi guys, welcome back. I know for you it wouldn't be welcome back because the video just continues. Okay, so we have finished with the consolidated statement of profit or loss and other comprehensive income. So we will now use the bottom section right here as part of our preparation of the consolidated statement of changes in equity. Okay, but first, before we get to that, let us just finish our analysis of owner's equity of ordinary shares because we are not completely done with that. Let me just adjust this formula right here. Remember that this amount will be the sum of the amount of preference dividends, or ordinary dividends rather, plus these two. Okay, because this amount of 3806,248 was calculated by taking the sum of these items, and you will also include the, let me just remove that, and you will include this section right here. Okay, so your total right here should be 14,735,551. Okay, but we still need to calculate the retained earnings balance on the date of acquisition, and the only item that is missing will be the profit for the pre-acquisition period, which we have calculated in calculation 3, and that was 4,658,892, which was also the amount given in additional information point 9. Okay, this amount right here. Just as confirmation that we have calculated, or we have split the amounts correctly. Alright, so it will be 4,658,892. Let me just make sure. 4,658,892. Alright, that is the correct amount indeed. So your retained earnings balance on the date of acquisition will be the opening balance, which was given, plus the profit for the pre-acquisition period, and then we subtracted the preference dividends for the pre-acquisition period. Okay, remember we do not include any ordinary dividends here because the ordinary dividends were only declared at year end. Okay. Alright, so your retained earnings balance on the date of acquisition is 6,885,262, which will just split between the parent and non-controlling interests. Alright. Just for confirmation, it must add up to 6,885,262, and then we have calculated revaluation surplus. So the actual total would be the sum of these amounts right here, and then we add this amount. Okay. Once again, these two amounts should add up to 10,366,062 rand. And the difference between the total consideration paid by the parent, which was 8.56 million, as given in your trial balance, investment in Netix Limited, ordinary shares, and the parent's actual share in the subsidiary's equity at acquisition, which is this amount right here, will give you the goodwill amount. So the difference between these two will give you the goodwill amount. So goodwill paid by the parent for ordinary shares amounts to 785,454. Keep in mind that the parent also paid goodwill for its investment in preference share capital of 139. So in our consolidated statement of financial position, we will include both of these amounts as part of goodwill, okay, which we'll do a bit later on. Okay, so we have finished the analysis of owner's equity. So now let's turn to the consolidated statement of changes in equity. So as I've said previously, remember that this section right here will represent the total equity of the group, because it is the consolidated statement of changes in equity that is attributable to owners of the parent, and this one will be non-controlling interests, okay, which will be shown separately in your consolidated statement of financial position. Okay, so we will start with the opening balances for share capital. Once again, remember that the parent only issues ordinary shares, or only has ordinary shares in issue. Okay, no preference share capital there, and we have eliminated the preference share capital of the subsidiary at acquisition. Okay, elimination of the owner's equity at acquisition. Alright, so we do not include that balance as part of the group. Alright, so your opening balance for share capital would be 6,385,000. So 6,385 for ordinary share capital, if you want to be more specific. And if you look at point 2 again, remember that the issued share capital of both companies remained unchanged. So the opening balance will remain unchanged, or this will also be the balance at incorporation of Renet Limited. So there's no change to this amount right here. Okay, so we just input it as the opening balance, and it will also be the closing balance on the 31st of March 2020. Alright. Then we get to retained earnings. Now remember that on the 1st of April 2019, the group did not exist. Okay. So the opening balance for retained earnings will just be that of the parent. Okay. We do not add the parent's share in the subsidiary's retained earnings yet. Okay. We'll get to that. So balance at the 1st of April 2019 only for the parent, and this amount was given as 6,359,900. So 6,359,900. This was the balance given in the trial balance. 6,359,900. We have already eliminated, or we have taken into account, retained earnings balance of the subsidiary. So please just ignore that. Then revaluation surplus. Now, according to additional information point 3, there was no revaluation conducted by the parent in its own financial records. So therefore, this balance right here will also be the opening balance for revaluation surplus for the parent. So 3,189,650 would be the opening balance for revaluation surplus. We have already dealt with the subsidiaries revaluation surplus in the analysis of owner's equity, which will be eliminated at acquisition. Okay, and then we have used this amount to calculate the current year's revaluation surplus. Once again, we will get to that. We are only interested in the balance on the 1st of April 2019. Okay, and this amount will only be that of the parent, 3,189,650. Then for non-controlling interests, okay, would be 0. Why? As I've said, the group did not exist on the 1st of April 2019, so therefore there could not have been any non-controlling interests. So the opening balance for non-controlling interest would be 0. Okay, there was no balance for non-controlling interests on the 1st of April. So therefore total equity at the beginning of the year for the group is 15,934,550, which is in effect just the equity of the parent. Okay, right. Then we have a second item, or our changes in equity for the year. So the first one being equity at acquisition. Now remember, we will only include this line item in the consolidated statement of changes in equity if the group was formed during the current year. Okay. I will work through another question where the group was formed in a previous period. Okay, then this item will not be included. Alright. So equity at acquisition, we are only interested in non-controlling interests. Okay. So what was the balance of non-controlling interests at acquisition? Now remember, we need to take our preference share capital into account as well as our ordinary share capital. So for our ordinary share capital, the total balance of non-controlling interests at the date of acquisition, as we have calculated in the analysis of owner's equity, would be 2,591,516. Okay, this is the balance of non-controlling interest at acquisition for the ordinary shares, and then for your preference shares it would be 44,000. So the sum of those two will give you the total equity for attributable to non-controlling interests at acquisition. So the balance for NCI at acquisition, as you will show it here, would be 2,635. Let me just make this right. 635,516. Okay, this is the total amount attributable to non-controlling interest at acquisition. Okay, this is the balance of NCI at acquisition. 2,635,516. Okay, now we get to, so our total will also be 2,635,516. Remember, for each item you need to include a total as well. Alright, now we get to the total comprehensive income for the year, and these amounts will be taken from the consolidated statement of profit or loss and other comprehensive income. Okay, but the tricky part now is that we have to take the amounts that we have calculated here at the bottom of the statement of profit or loss, and we have to calculate what amount represents other comprehensive income and what amount represents the profit for the year. Okay, this is a bit tricky. Okay, now for the parent, in order to calculate the revaluation surplus, remember, because there was a revaluation surplus. Okay, so this amount right here includes the portion of that revaluation surplus that is attributable to owners of the parent. Okay, so what we will actually do is that for the profit for the year, okay, and we know that the profit for the year will be credited to the retained earnings account, meaning it will increase the retained earnings account. Alright, so we will take the total that we have calculated here, which is 15,971, pardon me, 15,971,351, and then we will remove the parent's share in the current year's revaluation surplus, and that amount was calculated in your analysis of owner's equity for ordinary share capital as 267,750. Alright, and you should arrive at an amount of 15,703,601. Okay, so this is the amount that represents profit for the year, okay, attributable to owners of the parent, 15,703,601, and the other amount of 267,750. This represents the parent's share in the current year's revaluation surplus, which we have calculated here in our analysis of owner's equity. Okay, that was covered in part 1 of question 2. Okay, and if you add these two amounts together, and remember that the parent's portion of revaluation surplus would be shown in the revaluation surplus column. So therefore, the sum of these two will just give you the total comprehensive income attributable to owners of the parent. Just let me show this correctly. 267,750, because remember that the 267,750 is other comprehensive income, so it needs to be showing that line. Okay, so just make sure that you have shown that correctly. Okay, the total 267,750. Then for non-controlling interests, okay, we will follow the same procedure. So we will take the total of 1,043,892, and we will subtract the amount for revaluation surplus, 89,250, which we also got from our analysis of owner's equity of ordinary shares. Okay, 89,250 represents other comprehensive income attributable to non-controlling interests. So the profit for the year that is attributable to NCI would be 954,642. Okay, 954,642. And then you will just show the 89,250 as other comprehensive income attributable to NCI. Okay, so therefore total comprehensive income for the group will just be the sum of these two, and that should also give you the value of revaluation surplus for the current year, which is 357, as we have shown in our consolidated statement of profit or loss and other comprehensive income. So total comprehensive income for the year for the group would be 17,015,243, and this one should correspond to the amount right here. Okay, these two need to be the same. Okay, 17,015,243. Okay, the difficult part here is to split the totals between the profit for the year and other comprehensive income, because you now have to take the parent as well as NCI into account. Okay, so make sure that you follow that calculation or study that calculation very carefully. Alright, because it is quite a tricky calculation. And then we have dealt with the dividends already. Okay, we have shown the dividends paid by the parent as well as the dividends paid to non-controlling interests. Okay, remember we have eliminated intergroup dividends already. Okay, and just for the sake of making sure that we have calculated all our amounts correctly, so the closing balance would just be the sum of this. Okay, and we'll just copy the formula. Okay, and then for your NCI, it will also be 3405,261. We just need to adjust this total right here because that is not correct. This will be the sum of this section right here, because remember that the 17,015,243 was calculated by adding these two amounts together, so we cannot add it twice, and then we need to add this portion right here. So that should give you 35,112,762. Okay, so we are done with the consolidated statement of changes in equity, and now we can move to our consolidated statement of financial position, which is our final group financial statement that we need to draw up. Just something that I forgot here, the unrealized depreciation of 2,900. Please refer back to additional information point 6. Okay, we have calculated the unrealized depreciation. We have not yet taken into account right here. And that was also calculated in calculation 1, the analysis of owner's equity. Okay, nothing else that will affect property, plant, and equipment. We have added land and buildings as well as property, plant, and equipment. there is no accumulated depreciation balance. So we assume that the balance for PPE will be at carrying amount. Alright, we have removed the unrealized profit and the unrealized depreciation. Remember, this one needs to be added, This one needs to be added because we have decreased accumulated depreciation, which will increase the carrying value of property, plant, and equipment. Okay, so that one is added, not subtracted. Okay, and if we calculate that, let me just do my calculations. 6162970, 2675 800 plus 3579073. Remove the unrealized profit of 87 and add back the unrealized depreciation removed, and that will give you 21076,703. Okay, that is the value for property, plant, and equipment for the group, 21076,703. Then the amounts for goodwill, we will refer to our analysis of owner's equity. So in our ordinary shares, or for our ordinary shares, it would be 785,454. Okay, 785,454. And then we will add the amount for goodwill paid for preference shares, which is 139. 139. And we have calculated those amounts in calculations 1 and 2. Alright, so total goodwill will amount to 924,454. Okay, giving you a total for non-current assets of 22,001,157 Rand. Okay. Then we move to our current assets section. We have calculated the amount for goodwill already, 15,929,595. Remember, this one was the unrealized profit included in closing inventory. Then your trade and other receivables, there was no adjustment there, so we will just add these amounts together. So you will take 206,920, and we will add the subsidiaries amount of 1,270,620. Okay, that's fine. 1,270,620. Okay, we have dealt with inventory, so no need for that. We have eliminated the investment. Sorry guys, I'm just removing the items that we have dealt with already. We have dealt with the other income revenue. That's fine. We have dealt with cost of sales and other expenses as well. Because by crossing out these amounts, we can only focus on the remaining amounts. Alright. So trade and other receivables for the group would be 3,333,450. Okay, 3,333,540. And then your cash and cash equivalents, we have bank. Okay, Ethernet bank is given as a debit balance, so here's a favorable bank balance. There's no bank overdraft. So we'll just add these amounts together, 125,800. And then you add the balance for the subsidiary, which is 85,600. Okay, that should give you a total balance for the group of 211,400. Right, so your total assets amount to 41,475,692 Rand. Okay, so we know that our total, or our equity and liability section, should also amount to this amount. Okay, so we are done with assets. Just something else that I want to address. If you look carefully at your trial balances, you will see that there is an intergroup loan. We have a loan from Renet Limited and we have a loan to Netex Limited. Okay, and they are equal in value, and we know that we are supposed to eliminate intergroup loans because the group cannot have a loan account with itself. Okay, an intragroup loan accounts must be eliminated. There is no transaction that needs to be recorded in those accounts. Okay, so we just remove those or eliminate those against each other. We have dealt with share capital. Okay, so now we move to our equity section. So these balances right here will just be taken directly from the consolidated statement of changes in equity. So your share capital would be this amount right here. Your retained earnings will be this amount. And other components of equity would be 3,457,400. Okay, remember we do not show the item revaluation surplus because there can be other components of equity. So on your consolidated statement of changes in equity, you just keep it as other components of equity. But you know that revaluation surplus forms part of that amount. And then for non-controlling interests, we have calculated that to be 3,405,261, giving you total equity of 35,112,762, right, which corresponds. Okay, then our liabilities. We have a long-term loan from Init Bank. Remember the loan from Connect Bank, according to additional information point 7, was settled in full on the 1st of December 2019. That's why there's no balance for that loan. So the only long-term liability or non-current liability for the group will be the long-term loan from Init Bank, which is 271,100. Okay, long-term borrowings, 271,100. Okay, and then we just need to account for trade and other payables, which is 2,258,930, 2,258,930, and then we add 3,832,900. Okay, and that should give us the total for trade and other payables. Okay, which is 930 plus 3,832,900. So that will give you 6,091,830. Okay, so your total current liabilities would be 6,091,830. Remember, there are no dividends payable. Okay, those dividends have been declared and they have been paid to the shareholders. Okay, so no dividends payable. There's no balance for dividends payable. Okay. All right. We just subtracted these balances from retained earnings in our consolidated statement of change in equity. That's fine. Let me just format this correctly. We will format it accounting, 0 decimal places. We do not want a currency. Okay, so your total liabilities would be the sum of this and this one right here. So your total equity and liabilities amount to 41,475,692, which is the same as your total assets. So our consolidated statement of financial position is in balance. Okay, now this concludes question 2 for the May-June 2022 exam paper. As I've said, they only required you to do the consolidated statement of profit or loss and other comprehensive income, as well as the retained earnings, revaluation surplus, and non-controlling interest columns. So if this was the official examination, you would have just needed to show the requested columns. Okay, but for the sake of proper exam preparation, I've decided to include all the consolidated financial statements in full so that you can prepare thoroughly for the examination. And as I've also said in this lesson, this was a very difficult question. I will not lie about that. Okay, it was pretty difficult. And once again, this is about as difficult as it gets. Right, so if you are able to understand the principles covered in this question, you are most or more than halfway there. Okay. But obviously it's important for you to work through other questions as well. And I believe for the next lesson, I'm still deciding in which order I'm going to do it. I will be working through question 12 in tutorial letter 102, which covers, or basically that question, or in that question, the group was formed in a previous period. Okay, so we will then see how we're supposed to calculate all our respective amounts. But for this question, all the consolidated financial statements were drafted, and this should help you to properly prepare for the examination, which will take place on the 24th of October 2022. And yes, as I've said, if you've managed to do this correctly, you should manage with the examination. Alright, that is all from me for today. I'll see you in the next lesson. Stay healthy, stay safe, and I'll see you in the next one.